the rating that looks more modest on paper. This is an important thing I think that people should be aware of. When you look at the P ratio, the rating, it looks more modest. But the difficulty evaluating this business from a P ratio is there are so many accounting adjustments. When you're acquiring businesses all the time, they adjust loads and loads of items, and some of which we don't agree with at all. Like when your business rationale is to acquire up other companies, how can you ignore the cost of acquisition and integration? Because they're recurring every single year. They're a real cash cost of doing it. We don't buy into that at all. When they report these companies, they like to ignore all these costs. We would urge people to always look at the cash flow potential of what cash can this business generate. And that's still pretty encouraging for keywords.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello Chris, good to see you again.
Hello Lee, good as always.
Yep, another jam-packed episode. We're going to discuss crypto, Trainline. We've got the competition watchdog is launching a probe into the vets market, which we've mentioned in the past. Fonix Mobile, Pawnbrokers going cheap, some bonkers bargains to look at. But before we get into all that, the Financial Conduct Authority said that it would not object to the creation of a crypto asset-backed exchange traded notes for professional investors. So this has helped Bitcoin rise up close to $71,000 now, or actually surpassed it. What's your thoughts on Bitcoin, Chris? Being an investor of multi-decades, runs a fund.
Yeah, I struggle with it. Look, I'm not averse to speculation of a kind, but I try and value businesses, evaluate what the business model is like. I look at financial statements. I try and see in the everyday world how that business is doing, put some practical elements to it. But you can't do that with Bitcoin at all. It's just strange. I to be honest, I struggle with gold as well. And gold price is riding high, but Bitcoin, crypto, it just seems no controls over it, really. And there are countless other cryptocurrencies, lookalikes, that are being developed and launched all the time. I don't know how many there are now, but loads of them. And yeah, I just struggle with it. I struggle with trying to assess a value. But clearly, as a speculative play, it's been terrific for some people. They made an awful lot of money on it, assuming many have cashed in. Even those that have ridden it from very early days, if they haven't, they've done fabulously. And I think the important thing is that people don't realize, believers or non-believers, it is sucking a lot of capital out of markets, equity markets. So in the early days, when people would have been looking for something more speculative, smaller companies, they're now got this temptation of playing crypto in some form as the high risk play. And that is an issue, I think, for equity investors, and they can't ignore it. Those that do have really got their head in their sand a little bit.
Do you know anyone who's actually made a real serious amount of money off this?
Not personally, no. None.
No, I don't either. No.
I've heard some great stories, and you hear I think the Winklevoss twins that were around about with Facebook's launch, they apparently have done very well out of it.
Yeah.
But I've never, personally, I don't know anybody.
Yeah. No, I just think it's interesting, isn't it?
I've spoken to some people that had a little punt on it and made relatively small amounts, but nothing really substantial. It's all short-term gambling almost.
My point there is the headlines will say, oh, Bitcoin is X thousands of percent, but who's actually held on for that length of time to really realize those gains? Probably, maybe a very small percentage of people in the world.
Yeah, it's a fabulous one for the traders. They must love it. People that like a bit of a short term, take a bit and maybe lose a bit the next time. Great for them.
Yeah. So the other big news as well is the UK competition watchdog launches probe into the vets market. Now, you're a long-term holder of CVS Group, hold it in a fundamental asset portfolio. What's your thoughts on that then, Chris?
Yeah, look, it's not good. And we had news about the review beforehand. And now they've effectively say, look, we've had a quick look. Now we're going to dig a bit deeper. We think there are issues around pricing, transparency. There's been a lot of consolidation in the sector with lots of big multinational groups buying up veterinary practices. So it's not, in some respects, it's overdue. CVS has taken a real battering. They dropped from when it was first announced, the very first reviews, they've lost about 400 odd million in value from a company that was worth 1 point something billion before. That's quite a sum. Does that really reflect the loss in their business? No, I don't think it does. I think they've also been investing a lot and have proven themselves to be quite a reasonable operator. I think the pricing issue is the key. Vets have got to be more transparent in their pricing so customers have greater choice. But, you can't get away from it that if you go and see a vet, how often do you hear, put differently, how often do you hear stories about long waiting times with veterinary practices, waiting for an operation, or problems of that nature, getting through? That's not the issue here. And people have got to realize for good health service, unfortunately, it costs. Vets themselves don't earn very much. They're not high earners or corporate operators. The margins aren't huge either. Some of their businesses where they're putting it into their specialist referrals and they're making bigger margins, but the core veterinary practice isn't making a huge amount of money. But yeah, I think they need to be proven to be more transparent. That's clear. But we're confident in terms of CVS Group. We think the shares look decent value. They're expanding a lot now in Australia. They're using a lot of their cash flow from the UK business to support growth in Australia. They've got a huge funding line as well. And so I think it looks, it could be an interesting one. When the CMA start looking at stuff, it's not without risk. You don't know what they're going to say. So I
Yeah.
appreciate some people may be put off.
What's the worst case scenario in this?
Very worst case, there might be a ceiling on prices. Medicines as well, they might cap those. CVS has got his own online dispensary business called Animed, whose margins are minuscule, but so there is the option to purchase through that at lower cost. But yeah, there might be a cap on service rates. That sounds very hard. It'd be quite hard to control. I think for them, the lesser thing with they may demand that they offload some of things like they've got a crematoria business as well. They've got a diagnostics center as well. So they may ask them to offload some of those other services where they may be capturing more margin. So perhaps they can't be owned by the veterinary practice. Who knows? I think the core business, growing pet population, the fundamentals of the sector still look pretty reasonable.
Yeah, best case scenario, they say make your prices more transparent, let people know there's other options perhaps.
Yeah, absolutely. People need choice and they need to know as well if they're going. I think the other issue as well is people weren't aware that they were actually going to a corporate owned vet because many of them retained their original names and they look like private practices. Maybe people are uncomfortable going to a huge group owned by, for argument's sake, Mars is one of the biggest pet owners in the world. They own practice in the UK, Mars, as in Mars bars.
Wow.
They own lots of pet food companies as well. They are
Yeah.
Mars is absolutely huge in pets.
Right. Well,
I
that's
probably haven't got
interesting.
a clue about that.
No, I didn't. No, that's really interesting. Can you imagine if you go to a vet and the name above the door says Mars?
It's
People, man.
I don't know, will it give confidence? It might do.
It might do, yeah, yeah. Brilliant. So moving on to our next company then, Vodafone. Vodafone's just announced that they are cutting their dividend, and Vodafone is part of the Income Boosters portfolio for Investors Champion. So what's your thoughts on that then, Chris? Because there'll be a lot of pension holders who will have Vodafone.
Anybody who's got a pension will have Vodafone. It's been a huge dividend payer, but really a sad, I call it relic of its former glories. But it said it's going to cut its dividend in a year's time, halving it to 4.5 cents from 9 cents. But the yield's still going to be about 5% even after that, because it's offloading its Italian operations to Swisscom for 8 billion, and it says it's returning some of 8 billion of that to shareholders, but via share buybacks. Now, the big issue here, it's unusual for a dividend cut for a company's shares to rise, and that's what's happened with Vodafone. As I say, the issue with Vodafone is less about its dividends, it's how it's going to really return to growth and be the innovative, dynamic company that it once was, which I think is really sad. This was dot-com era. This was an absolute pioneer, this business.
Like a lot of the companies in the last 20 years in the UK, the big stalwarts, they've not, shall we say, innovated as best,
No,
have they? So
no, it's frustrating. I should add, by the way, we're still holding it. Despite the cut, the yield's still really super attractive. You can see the shares have gone up, so we're going to stick to it still. The constituent are our income boosters high yield portfolio. So Investors Champion Income Boost portfolio, and we're still holding it.
we mentioned in last week's episode, Elliott Management was looking to buy Currys. Since last week, they've now withdrawn bids.
Yeah, they've withdrawn it. Huge electricals retailer, Currys, big presence in the UK market. It looks superficially cheap. It's got loads of debt as well. It's got some issues. Still, it looks very cheap. And Elliott now said they've tried to engage with Currys' board. They don't want to play ball, so they walked away. Share price has dropped a bit, but it's still higher than it was before this all kicked off, with the possibility that others may be tempted to step in and have an approach. But I think they've clearly got an offer an awful lot more than around current levels.
Do you think they might come back with another bid?
Not for a while. I think others are more likely. And quite frankly, you're buying Currys probably at the bottom of the cycle. Consumer downturn. Shareholders, the big players, should stick with it and ride this one out. You
Yeah.
get a bit of a dividend from them, great. I would be patient. I think if things recover, you're going to see a bounce in a 2 years' time. This price could be double where it is.
Interesting. We're going to discuss a really good trading update from a rare UK technology success story, Trainline, an app that I've used. I know you've used, Chris, and I'm sure many of the audience have as well.
Yeah, it announced recently. I think I underestimated this business. I think it's in really good shape. It's generating loads of cash. It was a trading update for its full year. Net ticket sales were soaring, where it rose 22%. All right, it's coming off lows, but it's now past pre-pandemic numbers. Group net ticket sales in the year increased to 5.3 billion. So it's responsible for selling tickets with a value of 5.3 billion. That's
Mm,
a lot.
that's
That's a
massive.
lot. Everybody says, well, I don't use Trainline. I use the train operators. It's cheaper. If you use the train operators apps, you're going to probably be using, this is in the UK, going to be actually using Trainline, even if you don't know it. Also, if you want to link across networks because of our ridiculous structure of the UK network, it's often easier to do it through I don't know what your experiences are, but it's a great little product, I think.
Yeah, I use Trainline whenever I book a ticket. I use Trainline. It's just so much easier, so much more efficient. And I think it is a pound extra they charge, but you pay for convenience, don't you? And ease, and it's just so much easier to use than any of the
Yeah,
actual individual
absolutely.
operators.
Yeah, it's my default app. That's the one
Yeah.
I look at. Just I'm going to London later, and it's the one I look at immediately. So, it's solution Trainline Solutions, which is the business that does provide the services to other partners. It could be other UK operators. Its net ticket sales were 31% higher last year to 785 million. So it's doing really well and growing strongly in Europe. This is not just about a UK play. It's been doing really well in Spain, really well there, and big opportunity. And there are lots of opportunities to sell ancillary products as well.
Mm.
They do a little insurance thing. You pay an extra pound or something, and you get an insurance product added on as well, which is high margin for them. Look out for more excitement. They're buying back shares as well. They generate loads of cash and they're buying back shares aggressively. So I think they're in a decent spot. Bigger write up on our Investors Champion site. People want to find out more about it. Our thoughts on.
Yeah, of course. And whenever we discuss some of these companies, there's usually in-depth articles on the Investors Champion website. Link is below in the show notes if you want to go and visit it. Shall we move on to AIM News?
Yep, as
There was-
always, got a bit
Yeah.
of AIM news. Plenty out at the moment.
Fonix Mobile, a company that Investors Champion has followed since its IPO in 2020.
Yeah, no, share price floated at 90p in 2020, currently £2.67. Hey, who
Yeah.
says you can't make a load of money on AIM? Brilliant.
Yeah. Yeah.
And it's timely actually because tonight, I think, is it tonight's Comic Relief? Is it Comic Relief? As
Ooh,
of the time of this interview, I think it's Comic Relief.
you're gonna test me on that one. I'm not sure.
I think it might be, and they're a big provider. They provide the mobile payments application for Comic Relief, and they do it for Children in Need. They do it for all the big sort of TV charity shows, and they're just going really well. Revenue in 6 months rose 21% to just shy of 40 million. They make terrific margins as well, great cash flow because they collect the cash on behalf of their customers. For the charitable shows, I should add, they charge a fixed fee. It's not a transactional based fee, but they're a very reliable operator and a great AIM success story. So Fonix Mobile, I would urge people to keep a very close eye on them. The management have done a terrific job since IPO. We were a bit hesitant because there was a big sell down on IPO. When they listed, they didn't really need any new money, but the insiders sold down a big chunk of their stakes. However, they still remain big shareholders, even selling down. And so that made us a bit hesitant. But this business is delivered in spades and really worth a look. I would urge people to have a look at Fonix Mobile, FNX's ticker.
With what they offer as well, they're offering, there's potential for growth international as well, isn't it?
Yeah, they've made the move in Ireland. They call it international, which seems to be going okay via our existing media partner. And yeah, there is a potential. I think they're testing it a bit there. And if
Mm.
it works, then yes, there are clearly, this could go much further afield. In defense of their listing as well, they didn't need it. It's given them greater credibility. The club partners now say, oh, you're a stock market listed company, which is doing them some good.
Yeah, I remember Rosemary Banyard on one of the interviews I did with her. She said sometimes the companies, just for the prestige of being listed, it helps them internationally grow.
Yeah, all the numbers are visible then. People can
Yeah.
see how they're doing. They can see in the marketplace what's going on. So I think that's really helped them. But yeah, good business. It's a bit Trainliney like as well.
That's what I was thinking.
They're running on a ticket charge through other people's payments. And the UK is actually good at this. Financial services related, payments related businesses. Some of them aren't massive, but they're pretty good at them. Good niche.
Nice to hear some good news coming out of the UK market for a
Yeah,
change.
yeah.
Another one that we talked about quite a bit on the recent episodes is the pawnbrokers, both Ramsdens and HT&T Group, doing really well, looking cheap.
Yeah, Ramsdens announced really another good trading update. Ramsdens prefers to call itself a diversified financial service provider and retailer. I like that rather than a pawnbroker for some reason.
Yeah.
Whereas H&T is happier and prouder to refer to itself as UK's largest pawnbroker. But both are doing really well. And they're so cheap. You're getting dividend yields. I think Ramsdens 5.8%. Earnings growth is quite flat. H&T's though forecast to grow quite strongly. It's got some big funding lines in. More and more people are pawning. It's nice secured lending as well. The average medium loan size is only £201. I think that's going to start going up because they bought a business making bigger loans to help other companies with their working capital. But you can see this is a business with lots of tiny, small loans for relatively short periods and secured on either high-end watches or gold jewelry. So pretty simple and well run. And Ramsdens, the difference between the two is Ramsdens has made a lot of money out of foreign currency exchanging, whereas H&T's core business has been pawnbroking in their pledge book. And H&T's pledge book is multiples the size of Ramsdens. But both, I would implore people again to have a close look. H&T in particular is really got some strong growth in there set to come through.
I'm sure the high price of gold is probably helping them as well.
Yeah, they're real winners. And I think people are disregarding that. They do really well out of the gold price. They don't like to make much of it because obviously it's transitory. That can
Yeah.
fall back as well. In the meantime, they're really making hay. The one downside is clearly their retail bit. Are they going to be a bit pressed there? Is the consumer going to be put off? And could that impact? The watch business was absolutely flying. That's already come off. These sales of high-end watches, people spending their COVID money on an expensive watch. That era's over, thankfully. But, they've still got other parts of their business look pretty encouraging. I visited their sites as well.
Right, okay.
H&T had a nice tour of an H&T site not long ago in London. It's really interesting, really neat businesses, simple sites. They're the sort of businesses that sweats their shop really
Mm.
well. They're either pawning stuff, selling jewelry, doing foreign currency, doing check cashing. There's a lot going on. And the site manager, the store manager, is so important. They know the local clientele really well. They get confidence with them. It's a really interesting offering, I think.
Should we move on to Advanced Medical Solutions, a world-leading specialist in tissue healing technologies?
Advanced Medical it's a big AIM company, 500 million market cap. It's been around for a while, but it's sort of been flying under the radar a bit. It's been struggling to really materially grow, but it has been investing a lot. It's been a bit over conservative, and it produces wound care as well and surgical wound care products. It's been innovating a lot. It's got a lot of new products coming through now. It's made quite a few acquisitions, and it also had a problem with the US distributor for one of its key products. And I think now could be a good time. Hopefully, all this investment is going to start coming good. But it's just been a bit of a laggard in the short term. But I think worth keeping an eye on it now. And we could start, I wouldn't call it a hockey stick, but we could start hopefully seeing some real growth returning to this business as new products which have received approvals get out into the marketplace and are plugged into their better distribution base. So, yeah, we're hopeful. As I say, we've held it in our portfolios for a long time. It hasn't really gone anywhere of late. Mind you, it's not alone in that respect. Yeah, worth keeping an eye on. But a big AIM stock that's popular with for AIM for inheritance tax planning portfolios.
Yeah, so you've held it in the fundamental portfolio.
Yeah, absolutely. Yeah.
Yeah, and there's another company that you want to mention. It's lost half of its market cap since 2021, and that's Keyword Studios.
Yeah, this has been a great AIM story. It floated, not sure how long ago, about 8 years ago. It's been a huge buy and build. So it's acquired more and more video gaming developers, all sorts of service businesses around the video gaming sector and the general entertainment sector. It's a 1 billion plus AIM company. It was much, much higher. The shares are probably half where they were at their peak, under half where they were at their peak. The founder that was the architect has stepped down. New CEO has been in for a couple of years now, I think. Again, the rating next looks more modest on paper. This is an important thing I think that people should be aware of. When you look at the P ratio, the rating, it looks more modest. But the difficulty evaluating this business from a P ratio is there are so many accounting adjustments. When you're acquiring businesses all the time, they adjust loads and loads of items, and some of which we don't agree with at all. Like when your business rationale is to acquire up other companies, how can you ignore the cost of acquisition and integration? Because they're recurring every single year. They're a real cash cash cost of doing it. We don't buy into that at all. When they report these companies, they like to ignore all these costs. We would urge people to always look at the cash flow potential of what cash can this business generate. And that's still pretty encouraging for Keywords. But is it much like advanced medical? Is it now it's had this bit of a lull? The heat has come out of the video gaming sector a bit, but it's still very much alive and still set to grow very strongly. Could this be now a good time to get involved? And because this business is a big player in its market, much like advanced medical, it's a pretty big player. I think Keywords is the largest dedicated service provider in the world, but it only has 6% market share, so still loads to go after, but a big major player on AIM. London's junior market has another market leader here. Keywords' client base is a really who's who of video gaming industry. It supplies everybody.
Do you own any of them in the portfolios?
Keywords we hold in our fundamental portfolios. We don't hold them in the Investors Champion portfolios, principally because a lot of the IC portfolios are larger stocks. Our Investors Champion aim for high yield portfolio focuses on dividend growth, but loads of coverage as well on Keywords.
Yeah, so Keyword Studios, 1.1 billion. And the next company we're going to discuss, a bonkers bargain, is called IXICO. And the market cap for that is 3.6 million. So it's a little tiddler in comparison to Keyword Studios.
Yeah, it's been an awful performer. Its shares are absolutely decimated. A little business called IXICO. It does medical imaging, sort of advanced analytics, principally focusing on insights in neuroscience. And it had been growing fast. Order book was building, but there have been a lot of contract delays, and its market capitalization is now tiny. It's 3.5 million approximately. But it's doing some interesting things. Is it worth more than 3.5? I would have thought so. There must be a lot more intellectual property value in it than that. The problem is there's no interest in these tiny stocks at the moment. But worth a look. There is a good order book which gives confidence. The problem is that order book is now being extended and some delays as well, which means that revenue is going to be lower than anticipated in the current year and indeed next year. But yeah, with all the talk around Alzheimer's and Alzheimer's drugs, this little business has some potential there. So worth having a look at if you want a
Yeah.
really speculative idea. But the shares aren't very liquid either in terms of the ability to buy them and indeed sell them. It's not that easy. There'll be quite a big spread. But have a look. It's got something of interest. It's got some value, I think, there.
Yeah, I suppose it ties in with the earlier conversation around Bitcoin. Maybe pre-Bitcoin days, these companies may have benefited from those speculative punters.
Yeah, look, if you've got a little bit and want to punt and it's easy to get in and out, you can do it on crypto. You can't do it on these small things. You get in potentially, but can you get out of the price at a sort of price without suffering a huge spread? I think that's a real issue. I would dig into the details of IXICO. Others are less inclined to do that. They just went, oh, that looks a good idea. I'll have a go at that.
When you say details, what sort of details would you dig into?
First of all, you look at the financial statements, its financial structuring, whether it's got any debt, just the basics there. But then more importantly, look at the market, the growth potential, who its client bases are, the nature of its contracts, the visibility of those contracts, the cost base, the management, who the shareholders are. So you just pick through everything to try and establish a rationale for why you think the shares in a business are likely to go up. And at the basic level, if you can buy them and if you can sell them. That last point is clearly an issue with smaller quoted companies. Often the price you're quoted is not the one you can ever buy in any size. And then if you want to get out and you think it's good, suddenly you discover, hold it, I can't.
Well, getting in and out of Bitcoin certainly isn't a problem, that's for sure. So we're going to finish the podcast off with 3 companies that Chris wants to bring to your attention, because it's not all about things looking good and things looking great. So there's 3 companies that Chris has identified that perhaps maybe the debt burdens are a little bit excessive. Something else for you to keep an eye out for when you're looking into these companies. And the 3 companies in question are Victoria, Gym Group, and Restore. And Chris is going to run through each of them. And as always, there's obviously always more in-depth articles on the Investors Champion website. So yeah, Chris, the first company we're going to dive into is Victoria, the maybe overly indebted flooring manufacturer.
Victoria is an extraordinary company. At heart, it's a carpet business which has evolved and diversified or grown massively into a general flooring group under a very ambitious chairman who I would implore people to look back at the history of it, who managed to engineer an amazing takeover of this business through deploying very little of his own money. He managed to take control of it. Anyway, he's then gone on his buy and acquisition spree and In short, the business is loaded up with mountains of debt, absolutely mountains of debt of one kind or another. And again, the headline numbers that are presented do not reflect what the really business is really doing. It's really all about, again, look at the cash flow. And when you look at the cash flow, look at the free cash flow, what the business is really generating after it's having to pay for capital expenditure. So, because typically this business has bought loads of new assets in other companies and then had to pay lots for restructuring them and also for putting in better capital equipment. So whatever it's paid is irrelevant almost to the future to maintain these. And so it's got all this debt. And despite that, we got news this week that despite deleveraging being a key target, reducing its debt, it's undertaking a share buyback, which is bizarre for me because that's going to not really help the debt come down materially. So whatever it's saving on one side, it's now going to pay a share buyback. It's going to use its money to buy back shares because it probably thinks the shares are cheap. But the executive chairman, as I say, has a reputation for some pretty jazzy and, from our perspective, somewhat worrying financial engineering. And if the consumer downturn lasts too long, if markets remain weak, it could be tricky for this business.
Are they a manufacturer or a retailer?
Manufacturer,
They do have
distributor, but they manufacture a lot. Yeah, I mean, this lot does everything now, all sorts of flooring. It owns I think, artificial grass company, ceramic tiles as well. Years ago, I remember visiting one of their factories in Kidderminster, a high-end carpet manufacturing. One of the scariest businesses I've ever seen. You got these massive looms
Yeah.
producing these high-quality carpets, all set up to pound out carpet. And all of a sudden, every few minutes, they stop. Because there's
Right.
been a tuft out of it, and it has to be reset again, and off we go. And this went on, and I thought, crikey, this is a tough old business that you want to do this. And these machines aren't modern either. They go back a long time, but it wasn't one for me. But an interesting experience.
Another one that we want to mention is Gym Group, again struggling with debt.
Yeah, I think the debt again of this one is there are two types of debt this has got. It's got its bank debt, but it's also got its leases. The lease commitments are starting to go through the roof. You open more and more gyms and you tie up for leases, and you're committed to those and paying those. Again, it's one that the cash flow number that I think management presents in the results does not reflect the true picture. Because we get free cash flow, and you can read the article that is dramatically lower than what management. But I'm interested in your thoughts on the business model of Gym Group.
Well, yeah, I mean, as I said in the last episode, I've been training for a lot of years and I've used Gym Group as well pre-COVID. I was a member for about a year and the gyms are really good, clean, good equipment. You can 24-hour. I think they do maybe one staff member at a time and sometimes I've seen two. So they don't have much in terms of staff available. The only concern I had is that as a business model, the competition out there is fierce. So in a small town where I live, we've got two other big national gym retailers, but we've also got four private gyms where basically local people have hired out a warehouse or a big place and filled it full of gym equipment. The competition in a relatively small town where we live is pretty fierce for Gym Group. And I just don't see how the business model can compete against that level of competition. And they're operating at the cheaper end of the market, which means that they're probably looking for new entrants to the market. That is going to be a highest churn rate as well.
That's my concern. They don't specifically mention churn in their numbers, but I assume it must be
Yeah.
substantial. Now, I'm not convinced, and I think this business has got big commitments. It's going too fast. I think it needs to be a bit more clever, a bit cleverer than just opening lots of gyms. There must be some ancillary product offering and other related to drive growth on it. I don't like this play of this looming lease commitment getting ballooning out of proportion.
Yeah, I agree. I think if one was to look at Gym Group as an investment, then what other income streams are they looking to bring online, or have they actually already got going? Just relying on the membership as fees, I'm not so sure that's a long-term success story.
No, no.
Yeah. Should we finish off with Restore, the last one?
Yeah, Restore's another business that's got clear growth problems. At its heart, it's an archive storage business. So it takes your paperwork, sticks it in archive files, takes it away and puts it in a big warehouse. And it's got other businesses attached to the way. It shreds stuff. It does IT recycling. Some of these have been hit, but the big growth area, cash flow comes from its archive boxes. That's sticky, but sticky. I think the lesson here is sticky businesses work both ways. It's very hard for them to nab customers as well. That's the other problem. They keep their customers, but how can they grab others? Therefore, they've been very much about a buy and build previously. They acquired other groups. And again, it's a business with loads of restructuring costs all the time. Now they're taking big goodwill impairments, which suggest, oh, they've overpaid for previous acquisitions. Ironically, the gentleman who was the architect, the former CEO and architect of the original model, which has brought them to where they are to a great extent, is now back at the helm trying to sort things out. And I thought it was quite amusing. They've said that rather than going for net box growth, which I remember, if memory serves me correctly, having looked at this many years ago, was the be all and end all. So getting more boxes in is selling more, rather than now the focus is going to be on making a better profit margin from them. I think they would have worked that out from the
Should have
word
thought
go,
of that
I'd have thought,
earlier.
yeah.
Yeah.
But yeah, it's a good cash generator as well. Perhaps they can sort things out, slow down a bit, and tidy it all up. The other difficulty, they're saying they're moving now to cheaper locations. That's all going to cost money in the short term. So again, you're going to have a short-term spike in restructuring costs for hopefully a long-term benefit. But if you do grow, what have you got to do? You've got to find more sites. These
Yeah.
boxes sit there for years. It's just a transfer of a cost from the previous business holding the boxes to another one. This business was set up as another one of these buy and build things. I'm not a great fan of them. I mean, you just keep buying businesses to achieve your growth. And yeah, and these were quite well-established legacy businesses. Nothing new about an archive storage business.
Shall we leave it there, Chris?
Yeah, we've gone through quite a lot.
Another lot, as we've said throughout the podcast. The idea of this is to give you a bit of a taster for each of these companies. For a more detailed, in-depth review, go to Investors Champion. All the articles are there, written by Chris and the team. And we look forward to speaking to you next week.
Thanks very much.
Well, that's it for today. Please subscribe for next week's episode, as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics, and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.